I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started.
Nick Minute.
Holy flippity flip flop flap and smokes, everyone. We have just got huge new news and huge new data to show, according to Morgan Stanley, that stocks could crash in a matter of months. Because the market has been rallying, hoping that the Federal Reserve is going to pivot, that we're in the disinflationary process right now. But no, people, we couldn't even be further from disinflation. We got a new PCE report and it definitely scared the markets. That is the personal consumption and expenditure. And this is the preferred gauge for the Fed. I guess because it's normally the lowest out of all of them, but this actually came out very hot, even higher than the CPI. We're also going to go over this new report from Morgan Stanley where they say stocks have entered the death zone. And on top of all of this, we got much more data that shows us that stocks is still expensive right now and it's not time to buy the dip yet. So everyone, this is definitely going to be a good one. So let's not waste any time. Let's get straight into the news, the facts, and the data. But look at this, everyone. This is very, very bad news for the Fed, because it's showing the economy is now starting to overheat. US consumer spending posts biggest gains in nearly 2 years and inflation picks up. But let me show you what's happening in this report, which is an absolute recipe for disaster. So look at this, everyone. Consumer spending increases 1.8% in January, but incomes only climbed 9%. Now, that is still very hot because that means we're going to have higher wages. That leads to higher inflation. Wages jump 0.9%. But we can see the trend here. Consumer spending is 3 times incomes and also double the rate at wages are going up. Now, this is what spooked the markets. The core PCE price index rose 0.6% and is up 4.7% year over year. So the Federal Reserve has made a very, very big mistake, everyone. He spoke too soon by saying the disinflationary process has begun. Now what we're seeing, consumers are spending like crazy, hoping interest rates will go down soon. We're seeing credit card debt absolutely skyrocket. Now people's spending is going up 3 times faster than their incomes. Now we know this can't happen forever, and I don't know why consumers are spending so much right now. We're about to enter into recession, but for right now, it seems like the economy is holding up much better than expected, but that won't last much longer because the Federal Reserve is now going to have to go above 6% interest rates because of that terrible, terrible mistake they made. And why don't they just rip the Band-Aid off? Why don't they just go to 5.5% right now, do a 1% increase at the next Federal Reserve meeting? I don't know why they're dragging their feet waiting. Well, I guess I do. It's because they don't want to crash the markets, everyone. But look at this. This is something not many people are talking about. We're still having more stimulus. The overall surge in spending came as wages and salaries jumped 0.9%, as they got an 8.7% cost of living adjustment, the biggest increase since 1981 for more than 65 million Social Security beneficiaries, offset a drop in government social benefits. That reflected the expiration of the extended child tax credit. So I think the markets forgot about this huge jump in the Social Security benefit. Yes, why it's not keeping up with the real inflation rate. Yes, why there's people still struggling. It still is a big increase, much higher than the Federal Reserve's 2% inflation goal. And this is going to mean that people can somewhat afford these higher prices. And that's what the Federal Reserve is really worried about, a wage price spiral, where prices go up, workers demand more wages so they can afford those higher prices, and then we go into this vicious cycle of higher prices and higher wages. Because look at this again, people, the markets didn't like it today, with markets now betting the Federal Reserve peak rate is going to be 5.4%. This is quite funny, everyone. I'm literally seeing this every single month now. The market goes, okay, we're going to go to 5% interest rates now. Then the next month, okay, 5.2%. Then the next month, 5.5%. They literally won't tell you where interest rates are really going to have to go because they don't want to spook investors. They don't want to spook the markets. They just want to slowly massage them. Okay, just a little bit more pain. Just a little bit more pain. Don't worry. Don't be scared. We saw this game they played throughout 2020. The markets kept getting it wrong again and again and again. They just increased their forecast by another 25 basis points. And who knows, could we be seeing in a year interest rates at 6, 7%? I definitely think we can, and so do a few market analysts and a few market commentators. After a lengthy period of subdued equity swings, volatility has been gaining ground aside from all the economic uncertainties that reflect a market that's gotten more expensive after an exuberant rally from its October lows. That's exactly right, everyone. I've been telling you, this is just a bear market rally. This rally is not off fundamentals. Sometimes the market can just rally off irrational exuberance. Stock investors think this is the lows, this is the time to buy the dip, then we get some momentum, people start to see stocks skyrocketing, they get FOMO, they jump in, and then that eventually we have a blow off top. Because even now we had a few investors buying the dip at the close thinking stocks are cheap. But no, everyone, I'll get into later in the video, stocks are still very, very expensive. So those gains have been dwindling by the day amid fears that a potential recession could further hamper the outlook for corporate America. This market analyst and commentator said there's little room for upside in stocks right now, given the inflation news, current market valuations after the January rally, and a weak Q4 earnings season. That's exactly right, everyone, and what I expect to happen as interest rates keep getting higher. Once people's credit card debts get maxed out, once their savings get drained, we're going to see weaker and weaker company earnings. So with interest rates rising and company earnings falling, we're going to have to see a repricing in the stock market to bring them back to fair value. Now, St. Louis Fed President James Bullard, he's seeing the need to act quickly to get inflation back under control and regain credibility. And look at this. This is something that nobody's even thinking about or nobody wants to talk about. Officials may need to raise rates as high as 6.5% to defeat inflation, according to new research that was critical of the central bank's initially slow response to raising prices. Wow, at least someone's finally talking about it, which I've been kind of harping on about forever. If you want to bring inflation down, you need to lift interest rates above the inflation rate. Right now, the CPI is at 6.4%. Well, simple. We just lift interest rates to 6.5%. Then once inflation gets down close to that 2% target, then you can start cutting interest rates. But what they're doing right now is they're doing very slow interest rate hikes, and they're risking inflation getting out of control. And once inflation gets out of control, there's no stopping it. So it's much safer to actually lift interest rates too high than not high enough. Now, with interest rates going higher, stocks are now going to start facing more and more competition by another asset class, and that asset class is the bond market. So look at this. Welcome to the 5% world where yields chases you. The dark cloud of rising interest rates come with some significant silver lining, because what happened in 2020 when interest rates were dropped to zero, what we had is a lot of retirees or people who are going to retire soon, they were forced into stocks because their interest on their bonds went to pretty much nothing. The 10-year went down to 0.5%. So they couldn't survive on the interest on their bonds anymore. So they had to sell their bonds and buy in stocks to try to get a dividend or to try to get some capital growth with growth stocks to try to fund their retirement. But if yields go to 6% or 7%, well, you're going to have a lot of these retirees and a lot of the baby boomers which are retiring right now. They're going to take their money out of the stock market, especially when prices are so elevated and there's huge risk. Why risk losing your retirement fund when you can actually get a risk-free return, unless, the US government doesn't default, of 6 or 7% with bonds? Now, I know what you're thinking. Well, if inflation's 6% and I'm only getting 6% yield on my bond, well, I'm really getting nothing. Well, yes, that may be true. Well, if you put your money in stocks last year, you would be down 15%. Plus, you'd have 6% inflation eroding away your purchasing power. Because like the old saying goes, it's better to get something than get nothing. Because look at these yields now, everyone. The 3-month, 4.8%. The 6-month, 5.09%. And the 12-month, 5.01%. So me, I'm personally not buying bonds right now because I'm young. I still have aggressive investing strategy. But we're going to see, like I said, a lot of these baby boomers buy up bonds because they can actually get some return on their money now. But okay, what you're here for, let's now go to this shocking report from Morgan Stanley where they say prices could crash in the stock market by 26% in a matter of months. So that's right. Morgan Stanley says S&P 500 could drop 26% in months. While recent data suggests the economy might be able to dodge a recession, they've also taken the responsibility of a Federal Reserve pivot off the table. And now we've just got this new PCE data that's definitely off the table. According to a team led by Michael Wilson, that doesn't bode well for stocks, as a sharp rally this year has left them the most expensive than 2007 by measures of equity risk premium, which has entered a level known as the death zone, the strategist said. That's absolutely right, everyone. Stocks, the risk to reward ratio right now is completely off the charts. Stock valuations are still crazy high. We're still going to see much more interest rate hikes coming. And a lot of investors don't realize, like I said, we're going to go much higher than 5%. I think 6%, maybe even 7%. And what if the unthinkable happens, everyone? What happens if inflation gets out of control and we have to lift interest rates like in the 70s and 80s of 10%, 15%, dare I even say 20%. This is something nobody's prepared for. They don't even want to think about it because we would enter the worst depression greater than the Great Depression because of the amount of debt that's in the system right now. The risk reward for equities now is very poor, especially the Fed is far from reaching its ending, its monetary tightening. Rates remain high across the curve and earnings expectations are still 10 to 20% too high, Wilson wrote in a note. Look at this chart here, everyone. Exhibit 6. It's time to head back to base camp before the next guide down in earnings. And he was ranked number 1 in last year's Institutional Investor Survey when he correctly predicted the sell-off in stocks. So that's right, everyone was bagging him last year, calling him Morgan Bear Stanley, but he actually predicted the 25% sell-off we saw in the S&P 500 and the 35% sell-off we saw in the Nasdaq. So others on Wall Street have also warned the recovery in the stock market may have gone too far. JP Morgan Chase & Co.'s Mislav said this week that bets on resilient economic growth and a Fed pivot are premature. While Bank of America Corp strategist Michael Harnett sees the S&P 500 dropping to 3,800 points by March 8th, implying a decline of about 7% from current levels. While we're even closer to that now, everyone. Morgan Stanley's Wilson is far more pessimistic and holds a view that the benchmark index can slide to as low as 3,000, a 26% drop from its last close in its first half of 2023. So everyone, how likely do I think this is to happen? I think this is very, very likely indeed, especially with all the new data we're getting right now, everyone. And I'll show you some few measures right now to show stocks are still overvalued. So look at this. This is the S&P 500 price to earnings ratio. Right now we're at 21 when the mean is 15.66 and the median is 14.9. So we could easily see another 20 to 25% reduction from here. But now for my last and most important indicator right now, something that nobody I see is talking about, is the money supply. What was all the talk in 2020 and 2021? Well, the money supply is exploding, so you got to get in stocks right now. Well, the opposite is happening now, everyone. The money supply is shrinking at its fastest pace on record. So that's right, everyone. Look at this. We can see the money supply has only been increasing every single year and has never decreased since 2008. It was around 7 trillion. And we can see here in February 2020, it went from 15 trillion all the way to 18 trillion in just a matter of months, and then it skyrocketed in 2020 to from 18 trillion to 21.7 trillion where it peaked, but now it is now falling, and it's fallen down to 21.2 trillion. So about $500 billion has been wiped out in just a matter of months, and we're going to see the M2 money supply continue to fall. So everyone, I know what you're thinking, well, okay, what does all this economic jargon and indicators mean for you in simple terms? What this means is, everyone, interest rates are going to go much higher than anybody thinks. I think we could easily go to 6.5%, even 7%. We're not going to feel the full pain, like I keep harping on about, until we hit peak interest rates. We're still in the fastest rate hike cycle in history. That's why right now everything seems fine, rosy, because we haven't felt the full pain and we haven't got all the data yet. According to this Morgan Stanley report and also my indicators, stocks are still severely overvalued and we need to see a crash in the markets to bring them back to fair value. Also, the money supply is going down for the first time in decades and its fastest pace ever on record. And this means a lot of these assets that soak up this money supply, well, they're simply going to have to go down as well. But everyone, what do you think about all of this? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.